All right, futures are now a little bit higher, bouncing back and forth between gains and losses. We have 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment, and Bloomberg Open Interest starts right now.
Coming up, capping chips. The U.S. May limit the amount of sales or continue to limit the amount of sales of AI chips to other countries. We'll analyze that and what it means for American companies. Meanwhile, looking under the hood of big banks, B of A has a beat. Goldman's profit jumps 45%. It's a big beat. We'll bring you all the headlines. Everybody's beating on trading. Plus, bolstering Boeing, the struggling plane maker, files to raise as much as $25 billion in a bid to boost its liquidity. Is anyone buying, though, is the question that we'll ask. First off, let's take a look at where markets are trading after the 46th record high on the S&P 500. Right now, futures are up just a bit. They have been down earlier in the session, so you could see some fluctuation there as we head towards the open. NASDAQ futures are equally unchanged right now, and the bond market is back after celebrating Columbus Day yesterday. We have yields down 5 basis points, but still on the 10-year more than 4%. Katie?
All right, let's take a look at some individual names. We're talking about bank earnings names because they came in strong this morning. You've Goldman, Bank of America, Citigroup, all higher in pre-market traders. Of course, traders stepping up in a big way at the big three. Meanwhile, Schwab surging after an earnings beat. The bank said it cut down some of its expensive debt, also beating on earnings. Shares currently up about 8%. And Boeing. Matt, you know I really want to talk about Boeing. And the story just gets more interesting because, as you said, planning to raise up to $25 billion to shore up its balance sheet and get through the current production strike, as well as maybe fend off potential ratings downgrades from Moody's and S&P Global. The stock has been bouncing around all morning, at least for right now, Matt, currently up about 0.8%.
All right, and I mean, we are going to get to Boeing. Don't worry, Katie. We'll talk about this iconic American company in free fall, I promise. But first off, take a look at this. There has been, as we've been talking about, a broadening out in terms of earnings support. The blue lines here are Magnificent Seven year-over-year net income growth. The white line is, I guess, the S&P 500 at large, its year-over-year net income growth. And you can see that for a while, the Mag 7 had been leading. The middle of the chart is really 2024. So starting in the June quarter, it turns around, and hopefully this broadening out will continue. The rest are estimates. But we are kicking off earnings season.
We certainly are. And it's nice to see, of course, that those white bars are getting bigger. I think that's good news. I do want to bring your attention to Bank of America had a fund survey out, a fund manager survey. In October, it showed the biggest jump in investor optimism since June 2020 on Federal Reserve cuts, what's going on in China, soft landing, et cetera. I thought that was interesting because they're talking about positioning here. You think about what Cole Smead told us yesterday, that positioning is looking a little bit exuberant. You add it together with what we learned from Bank of America, and you could sketch a bear case right now, Matt, if you wanted to.
Yeah, all right, I was listening to a bear on radio this morning. I want to talk a little bit about what
was his name?
He said. Mike Wilson was talking to us this morning about the rally being driven in his reading of it sheerly by multiple expansion. I want to bring in JPMorgan Asset Management Global Market Strategist Stephanie Aliaga. And Stephanie, I want to ask you about this. You know, Wilson, of course, he's a known bear, but he was saying this is all about multiple expansion. We're not seeing an increase in earnings that's driving prices up. But you point out something that this chart just showed us as well. We've seen a broadening out in earnings.
We have, and we think that broadening out in earnings is also just getting going. You know, this year, or this quarter really, we do expect that the Mag 7 will continue to dominate just overall S&P earnings growth. But underneath the hood, there's some really significant bifurcation happening. You have other areas of growth. You have, you know, healthcare, communication services also showing really solid 10+% earnings growth expected this quarter. And then looking beyond, we're really expecting to see that broadening out take greater hold. And that's just because when you look at the overall market landscape right now, you have some really significant tailwinds underway. You have interest rates coming down. That's going to help many other areas of the markets that have really underperformed recently, particularly financials. You also have a resilient consumer, a resilient economy, the potential for perhaps manufacturing activity to also pick up going forward. And then you also have the AI theme, which has been the wind behind the sails of these Mag 7 companies. That story is also now showing a much broader set of beneficiaries that are on the receiving end of all of this CapEx, areas like utilities, industrials, and that is also very nascent. So we think, looking at those drivers, we have more conviction that this broadening out in earnings growth really has more room to run, and that is providing a more durable support for the markets right now.
When do we expect to see a return on investment in the AI space? Because so many billions of dollars, tens of billions being thrown at it, and the question has been asked for the past couple of quarters, when are we going to make money on this?
It's an important question, and I think it also hits at one of the biggest uncertainties around the AI theme right now, is that we're talking about a secular technology. AI adoption is going to take time. It should take time. And it could take some time for the ROI on some of these investments to really take hold. But what gives us more conviction that this is not an overextension in terms of investment is if you look at the hyperscaler spend as a share of their operating cash flow, it actually hasn't grown that much, and it isn't expected to grow over the next 2 years. While CapEx is growing, these companies are just so profitable, they have so much cash on hand already, that they're able to use more of that cash to invest in R&D and CapEx. And while those companies have reached record high concentration in the S&P 500, what's also really significant is that the top 10 companies account alone for 40% of S&P R&D. And that is really backed by really solid cash balances amongst these names.
Should that make me nervous, or is that a reason to spend money on those names? I mean, the narrative is out there that you want to buy the companies that other companies are spending money on rather than, focusing on these consumer stocks. But how are you threading that needle?
I think it is such an important distinction when looking at the quality makeup of the top tech companies leading the way right now versus the last time we were in the midst of a transformative technology. Let's think about, the dot-com era. There you had this ragtag group of startup companies, didn't have any really real business plans for profitability. And now what you have are these large tech incumbents. They've been spending a lot, but that spend, I think, gives us greater conviction that they can maintain that pricing power, those barriers to entry, those competitive moats for longer, because they have that ability to really be more experimental and be broader with where they're investing that.
Yeah, it's a great point, of course, with all these comparisons that we get to the tech bubble. This time around, we're talking about very mature, very profitable companies, so yes, an important distinction there. Let's talk about that broadening a little bit more, though, because we were speaking to Jess Menton yesterday, and one of the notes she had for us that for the rest of the S&P 500, beyond the Magnificent Seven, that profits are expected to climb 1.8% in the third quarter. I'm used to the Amazons of the world. 1.8% doesn't sound that impressive to me, but...
It's true, and underneath the hood, there's as I mentioned, a lot of bifurcation, but I think in many of the sectors this quarter that are expected to see year-over-year declines in earnings or even roughly flat, it looks like that is set to inflect higher really in the fourth quarter because of some of those tailwinds, because of lower interest rates and really a more improved demand backdrop going forward. So we're a bit more constructive, and I think this quarter we'll just kind of have to see how some of those sectors really fare in light of
it's Tuesday.
It is.
Only 3 weeks until the election.
Yes.
And your birthday.
And my birthday on the same day, November 5th. In terms of the election, I mean, I've heard a lot of people saying recently it's still fiscal, right? We still have a huge drive there. And that's obviously not going to change regardless of who wins. Both candidates want to spend a ton of money that we don't have. But yes, do you make any other portfolio decisions, investment decisions based on your expectations for the outcome?
Right now, we think it is really far too soon for investors to make any decisions or pivots in portfolios around the elections or any kind of election outcome, because we just don't know. I mean, you look at the polling data, this race is neck and neck, and it's not only a question of who the next president is going to be, but what the makeup of Congress is going to look like, when that president is in office, what their priorities really end up being, because oftentimes that can be different than what they're talking about on the campaign trails, who they staff their cabinet with. Once we have more clarity around all of those, I think we can have a better sense around the direction of policy going forward. But to your point, like, there are still some of these more secular trends that are related to politics that are likely going to prevail regardless of the outcome. Things like deficit expansion, things like geopolitical tensions, or just the restructuring and reshoring of manufacturing activity. These are secular trends that are likely going to remain intact. It's just a question around, on the margin, how things really change over the next few years, given who this next president might be.
Well, it's a good reminder, too, that there's a lot of overlap when you take a look at the Venn diagram. Stephanie, great to see you. Really appreciate you taking the time. That is JPMorgan Asset Management Global Market Strategist Stephanie Aliaga. Meanwhile, let's take a check on futures right now. About 20 minutes until the bells ring, and boy, is it boring. You have the S&P 500 pretty much flat on the day. An optimist would say that's 0.1% higher. We know we got our 46th record close yesterday. Same thing, too, if you take a look at the NASDAQ 100, just a little bit higher after such a big day yesterday. Taking a little bit of a breather. The Russell 2000, though, decidedly lower, currently down about 0.3%. Let's take a look under the hood now. We'll do that with Abigail Doolittle.
Lots of earnings movers to take a look at, starting off with the shares of United Healthcare, the healthcare giant. These shares are down sharply, the better part of 10%. This after they beat on the estimates for the quarter that was, but they trimmed the top side of the full year outlook. Investors, analysts not very positive about this. Apparently medical costs really higher. Walgreens, on the other hand, up 4.2%, and they raised their 2025 sales view. They also gave more color around store closures, saying that they're going to close about 14% of the store base. That is clearly being cheered for this company. Turning to some stocks that are trading in the opposite direction of what they had been trading within the chips complex. Nvidia, very close to its all-time high, but today paring back a little bit, just off of those highs. And then Wolfspeed soaring up 30%. They are expecting up to $2.5 billion in additional capital between the CHIPS Act, new financing, and a cash tax refund. And then finally, DJT, the Trump trade, well, it's back. The shares of DJT right now in the pre-market up about 9%, up for a fourth day in a row. If these gains hold on the open, and it's really pretty incredible, Matt, from the recent lows, this stock up about 150%. One way of the market saying, and the betting odds, also the predicted betting odds leaning this way too, that the former president, Donald Trump, that the markets are favoring the odds of his reelection over VP Harris.
Hey, did you know, Abigail, we're going to actually have an interview? Wait, am I camera? I'm camera 5. Let me just do it too.
You are.
Did you realize that we're going to have the former president of the United States on our air this afternoon?
I did at noon.
Yeah, really looking forward to that. Donald J. Trump is going to come on.
Former president, current candidate.
Yeah, and talk with John Micklethwaite at noon. That's an interview that you don't want to miss. We are also going to dive into Schwab. Those shares up like 10% in the pre-market. Citi, best third quarter for its traders in over a decade. We're going to talk with about Goldman Sachs earnings. They had a blowout quarter for trading and investment banking fees. All of these big bank earnings. Up next with analyst Gerard Cassidy. This is Bloomberg. Getting out of high interest to look at what's making headlines around the world. Israel says it's weighing U.S. concerns over its retaliation against Iran, while at the same time asserting Israel has a right to act freely. Israeli Prime Minister Benjamin Netanyahu is reportedly agreeing to limit retaliation to military targets and avoid nuclear and energy infrastructure in Iran. Meanwhile, crude prices have been tumbling further in trading today. Right now, Brent crude down 4%, as is NYMEX. Bloomberg has learned that humans were remotely controlling some of Tesla's Optimus robot prototypes in its recent showcase. Elon Musk told the crowd that the humanoid androids would be the biggest product ever, but he didn't disclose the human helpers. The event was intended to generate investor buzz for upcoming products. And Donald Trump's latest town hall in Pennsylvania was derailed after multiple audience members fainted last night thanks to the sweltering heat inside the venue. The Republican presidential nominee had taken the stage 40 minutes before the medical emergencies. Trump pivoted from the usual Q&A format to transform the evening into an impromptu dance party. Trump will, by the way, sit down with Bloomberg's editor-in-chief, John Micklethwaite, for an exclusive interview exactly 3 weeks from Election Day. That's today. The conversation at 12 noon Eastern. Katie?
All right, looking forward to that one. But let's check back in on the bank stocks because they're rising across the board right now, reporting earnings for some of the big ones. And you're really seeing those trading desks capitalize on market volatility in the third quarter. Let's break it all down with RBC Capital Markets head of U.S. Bank Equity Strategy, Gerard Cassidy, who joins us now. And Gerard, just taking a look at some of the headlines on the terminal this morning. Goldman stock traders head to record. Bank of America bankers and traders help earnings top estimates. And then finally, Citi notches gains across the board as trading outdoes expectations. It seems like trading and the big beats we're seeing there are definitely a theme this morning.
You're absolutely right, Katie. The investment banking and markets results were better than expected. You touched on it with the volatility. You might remember back in early August when there was some difficult economic data that came out, markets swooned for a very short period of time. That gave opportunities, obviously, for the trading firms to potentially benefit from that. In trading and markets in particular, volatility is a positive. And if you have some volatility, they normally can capture that with higher revenues, as you pointed out.
What about investment banking, Gerard? I mean, it seems like everybody's beating on those fees as well. Does that mean M&A is back? Does that mean these bankers are charging more money? What do you see in the investment banking landscape?
Matt, what we're seeing is that debt capital markets in particular were strong. We saw some of the banks indicate that after the Fed cut rates, yields fell in the capital markets area for the DCM market, and issuers captured and rushed out and issued debt. But to your point, the M&A advisory fees are also picking up, and I think there's evidence now that if the U.S. economy continues its growth, some folks were calling for a recession in 2024 or a year ago. That's obviously not happening. And so as industrials and corporates gain confidence that there's not going to be a recession, M&A activity could pick up even further, especially if the Fed continues to lower rates. It makes the financing of those M&A activities more attractive to the buyers.
Let's talk about net interest income as well, because we heard from Bank of America's CFO calling the quarter, quote, an inflection point on NII with it growing in the right direction. And maybe that's, of course, specific to Bank of America. But what is the overall narrative on net interest income? Because I thought heading into the quarter that we were expected to be underwhelmed there, but it seems like that hasn't been the case necessarily.
No, you're right, Katie. A couple of banks, in particular JPMorgan, benefited quite nicely due to rising short-term interest rates, and they've pointed out that their net interest income is going to be challenged in a falling interest rate environment. But most other banks, including Bank of America, are actually well positioned to benefit from lower rates as we go forward into the end of 2025, as their deposits reprice faster downward than their asset yields. Now, that also is going to be driven by the fact that you're going to see maybe a pickup in loan growth next year. The banks have had modest loan growth in commercial loans in 2024. And we think that if the economy grows 2 to 2.5% next year, we get the final regulatory rules known as Basel III Endgame, where banks know where their capital levels need to be, and demand picks up for loans, we could see stronger net interest income in 2025 due to loan growth.
Hey, I wonder about the outlook for consumers, Gerard. I was looking at a chart just now showing credit card delinquencies just continuing to rise. Do you see that coming through in the bank's reports, and what are they saying about, the outlook in terms of the U.S. consumer?
What we're hearing from the banks on the U.S. consumer is that they're healthy. The net charge-offs, which are different than delinquencies, of course, for all the big credit card issuers this quarter, JPMorgan, Wells, Citi, Bank of America, they all declined sequentially, the actual credit losses. And so I think what you're seeing is that there was that surge in delinquencies about a year ago that filtered through to the charge-offs. Now we're seeing some stability in delinquencies. So we think that the charge-offs or the credit picture for the consumer is actually is resilient. I know there was some concern about Ally earlier in September about higher losses in auto lending. We're not seeing that with the commercial banks.
All right, Gerard, great to get your perspective. Of course, that is RBC's Gerard Cassidy. Thank you so much. Of course, walking through today's bank earnings, bank stocks rising across the board. And we're not done yet because tomorrow, tune in for our interview with Morgan Stanley CEO Ted Pick. That's live here on Open Interest at 10:30 a.m. New York time. Now, coming up, less red lipstick, more red flags in the beauty biz. Details in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves on social media this morning. And first up, CoverGirl parent Coty is warning of a beauty sales slowdown. The company is trimming its sales growth forecast and saying that retailers are tightening their inventories because of weaker sales and demand trends. Next up, some good news. Charles Schwab reporting earnings that topped estimates, saying that it cut some of its expensive debt. Of course, the Fed's rate hikes were tough on Schwab's business as customers look for those higher yielding options. But executives say that the worst of those woes are behind them. It seems like traders agree. Shares currently up about 7% pre-market. And finally, Walgreens is planning to close 14% of its U.S. stores over the next 3 years as consumers increasingly turn to online retailers such as Amazon and discount giants, including Dollar General and Costco. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, let's get a check on futures right now. Of course, a little bit of movement, and I stress little because you take a look at the S&P 500, currently up about 0.1%. Of course, we closed at a record yesterday, and if these levels hold, of course, we'll close there again today, but there's a long way until 4 p.m. You take a look at big tech, too, also getting in on the action. The Russell 2000, your small caps, I can't say the same. Currently a little bit lower pre-market, down about 0.2%. Less than 4 minutes until the opening bell. We'll talk through the market action with Janus Henderson's Adam Hetts. That's next. This is Bloomberg.
All right, we are moments away from the start of trading on this Tuesday morning. This is Bloomberg Open Interest. I'm Matt Miller. If you take a look at futures, you'd be tempted to say, wow, this is so boring. I can just turn this off. I don't need to watch any market coverage today. But I would warn against that because the banks have come out with earnings and they have knocked the cover off the trading revenue ball. I mean, it's truly remarkable. We're going to talk with Adam Hetts about that in just a moment. There you hear the closing bells from TGS down at the New York Stock Exchange at the NASDAQ market site, MongoDB, which, 10 years later, I'm still a little bit concerned about whoever chose the name. MongoDB? Seriously? That's a publicly traded company. In any case, in terms of the markets right now, we are probably looking at another record, even if we only inch higher. That's because yesterday we had the 46th record close this year on the S&P 500, and we only need to see a slight green arrow to beat that. Katie, what do we see?
Well, don't take all of my talking points because that's exactly what I was going to say, that it's remarkable in that this is all you need for the S&P 500 to hit that other record, that 47th record. The NASDAQ 100, the arrow is now red. Of course, we're talking about very, very small moves here, but think about how far we've come. We're in a little bit of a vacuum now. I know that we're getting the big banks, not necessarily making a dent on the broader levels, but of course, we are ahead of a monster week or two of earnings. Meanwhile, the small caps a little bit lower right now, currently about 0.1%. Let's get under the hood, though, because that's where the real action is. And we start with Boeing, out with plans to raise as much as $25 billion as the plane maker seeks to shore up its balance sheet and withstand a strike that's hurting production. You can see that shares, they've been bouncing around, currently about 0.8% higher. And of course, we are keeping an eye on those bank earnings, and there's a lot of green on this screen. It's cut off a little bit, but maybe if we zoom out, you can see it, but it matches the color of the shirt. In any case, Goldman Sachs revenue, it surged above estimates thanks to its trading desk, capitalizing on volatile markets. Citi traders, similar story, turning in their best third quarter performance in at least a decade. Schwab, meanwhile, also beat estimates in a big way. That's why shares are up nearly 9%. Citi breaking the trend here, currently unchanged. It had been higher pre-market, Matt, now a little bit lower.
All right, and Let's switch sectors for a moment because Johnson & Johnson reported stronger than expected earnings, but it lowered its full-year guidance to account for its V-Wave acquisition. United Health, the insurance giant, lowered the top end of its 2024 forecast and issued 2025 guidance that missed estimates. And as a result, both of these stocks are lower. Let's take a closer look at the healthcare sector with Bloomberg's Abigail Doolittle. Abby?
And that's a pretty sizable decline for the shares of United Healthcare, down nearly 9% ahead of the open today. Over the last year, this stock up more than 12%. Now you can see it's up just 2.6%, and this really puts this decline in perspective. Investors very disappointed after the stock basically at a record high. Now, some of it had to do with rising medical costs, but in addition, in terms of the premiums retained, this came in a little bit less than expected at 85% versus the expectation. And if we put it into the context of all of the different insurers that have not reported yet, we can see that they're at 85.2%, Cigna, the estimated at 83%, and then some of these other companies higher. So investors are a little bit disappointed there. And then finally, they of course suffered a bit of a cyber attack, so that's hitting their numbers as well to the tune of $2 billion, more than $2 billion. What that could mean for the bottom line, it could be a hit of $2.40 for United Healthcare. So right around the loop, we have investors disappointed there. Those shares of United Health, again, down, Katie, by about 9%.
Yeah, it's pretty amazing. That would be its worst drop since June 2023. At one point already this morning, it was down by more than 10%, looking at its worst drop since March 2020. Really rocky start to the morning, really rocky reception for United Health. We'll continue to follow those shares. But let's broaden out this conversation now and bring in Adam Hetts. He is Janus Henderson, Global Head of Multi-Asset, and he joins us now on set. It's great to see you.
Great to see you too, Katie.
So I listened to a podcast over the weekend. It was with Kathy Jones of Schwab, and she said that the Fed basically is in risk management mode right now. And I think you could apply the same logic to the market, that basically, it's October 15th. We have a lot of uncertainty, but it's been a really great start to the year. How do you feel?
I think the Fed was in risk management mode, and then we had the 50 bips cut in September, that supersized cut. Then that was backed up by the job sprint that we had a couple of weeks ago, early October. So the Fed went from risk management mode to some reassurance on the jobs numbers. And now the market seems to be in risk on mode. So we're feeling like those cuts and the jobs print did usher in this soft landing environment once and for all we've all been waiting for. And now even no landing's coming into the conversation, which we think is great. We welcome those words coming back in as opposed to hard landing.
Yeah.
But we take that with a little dose of caution because it is still a late cycle environment. We'd much rather maybe hope for no landing and sort of plan and position our portfolios more for a soft landing kind of environment.
But we see, these markets have run up so far, so fast, right? On the S&P, we're up 23% year to date, up 36% from a year ago. Yesterday, we were talking with Cole Smead, who pointed out that U.S. households hold more stocks relative to other financial assets than they have ever since the St. Louis Fed began keeping records of that sort of thing in 1952. So I think of that because you're multi-asset, right? So are we holding too much in terms of stocks?
I don't know that we're holding too much. It's working so far, but that's one of the risks I think the market's a bit complacent about as we keep notching these all-time highs. So that wealth effect, that historic level of household assets in equities markets, all those exposures have been working. That's strengthening the consumer. It's encouraging more spending, but that will cut both ways because if, or more likely when, we do go from no landing or soft landing, wherever we are right now, to the inevitable hard landing, you're going to see that market drop in that bear market. And the more that households own, the more that's encouraged with spending so far, the more that can swing the other way and really turn sentiment down when those high net worth assets start coming way back down in that 20% plus correction.
Well, let's bring cash into this conversation.
Yeah.
Of course, we heard from Jamie Dimon last week, and I think it was on his earnings call that he was saying that cash is still a very valuable asset class, and certainly we've seen it's been very difficult for people to actually break up with their money market funds. From your perch, how are you thinking about cash and the role it plays in portfolios right now?
From the multi-asset perspective, on the one hand, cash is easier to hold than it's been in a long time. For a little while, cash was just a necessary evil purely for safety reasons when rates were at zero. And now you've got cash at really competitive rates. But a year and a half ago, when hard landing was part of every conversation and cash looked really attractive at 5%, people missed out 20% of returns in just that year, not to mention the returns we've had again this year over 20%. So that goes back to the point that even if you're seeing 4 or 5% cash rates in a long-term portfolio, I think don't be fooled by that margin of safety in cash. Cash can still be toxic to a long-term asset allocation. There are a lot of other attractive opportunities right now, even with that late cycle backdrop.
What are the most attractive? I mean, given the risks in equities, right? We're hovering at all-time highs. We have to expect a correction sometime soon. Given the risks to holding cash longer term, what do you think the best opportunities are?
Well, the top line multiples in the S&P at 22 times, that's some of the risk. That's 20% higher than long-term average multiples. And you couple that with double-digit earnings projections going forward, this gets into that Goldilocks price for perfection kind of environment. But where we think that this market still has legs is if it's not the Magnificent Seven concentrated passive indices, it's that broadening trade who's had these rate cuts, 50 bips. Maybe don't expect 50 bips going forward, but that drip of 25 bips, 25 bips, rest of this year through next year, that's going to help the more rate-sensitive small mid-cap companies inside.
We're going to keep seeing that if we get blowout jobs numbers, you know, and 3% growth. Why?
Because we're still in a restrictive environment. So that strength is great. That goes to that no landing type argument. Again, our base case is still soft landing. But if you have strong jobs and strong economy, we're clipping along at what, 3% still GDP for fourth quarter. So that's great. That doesn't mean the Fed needs to stay in restrictive mode when CPI is also coming down and inflation is not such a concern. You can get out of restrictive mode back to normal rates and get back to a neutral rate and that kind of outcome.
They're normalizing. They're not easing. That's
right. It just doesn't feel super restrictive to me. Like, where do you look to say, oh man, that's so restrictive?
You look at
the Fed's holding this economy back.
You look at the housing market. You look at car loans, for example.
But that's just because of high prices, right?
Yeah, but no, it's also because of high rates. But in any case, Adam, we've talked about the economy. We've talked about the Fed. Let's talk a little bit more about earnings specifically, because the big banks kicking us off. We got into some of the more interesting consumer-facing names next week, some of the tech firms, and there seems to be this divide between analysts and CEOs. A great story on the terminal is showing that analysts expect S&P 500 firms to report a 4.2% increase in third quarter earnings, but you take a look at guidance by the companies themselves, it implies a jump of about 16%. There's a lot of daylight between those two numbers. Where do you fall?
I think there's a good dose of skepticism in there. It'd be good to be critical. It's still this late cycle backdrop. I think look at financials, what we're seeing this week, and you're seeing what the market did yesterday. We'll see what the market did today. As you said, maybe boring start to the day, but not a boring show by any means. So we'll see what happens today. Yesterday, you saw a big jump in the markets. That relief of the earnings coming through on financials, a cyclical sector, some good news on NII, some good read through on the consumer. So I think you're seeing a good backdrop on earnings, but back to the other point, it has to be a good backdrop. The market's really demanding that to keep these all-time highs.
We are going to interview Donald Trump on this network in just about 2 hours. What would you like to hear from the president? Or what would you like to hear from Kamala? What do you want to hear from the person who's going to be in the White House next year?
The floor is yours.
Oh, thank you. I didn't expect that today. What a luxury. But I think what we want to hear is more certainty around policy from either side. And as we get more certainty of the next few weeks tick by up until the election, up until Matt's birthday, I think there's a lot of reason to celebrate as that uncertainty kind of resides. But in our view, really, elections matter, of course, just a few weeks ahead, and a lot of policy will be very important for the market outlook the next 12 months and beyond. But rates matter more than elections, and the economy matters more than rates. And it's on the latter two where we're getting a lot more certainty already. So I think that puts us in a pretty good situation.
Very cool.
Yeah.
This is better than Lululemon, right?
Yeah, I know.
This is better than Dave & Buster's.
I don't know if I go that far, but it's close.
Yeah, this was pretty good.
Adam, thanks so much for joining us. Pleasure having you in the studio. Adam Hetts there from Janus Henderson. Coming up, chip stocks like NVIDIA and AMD are under pressure as the Biden administration weighs capping sales to some countries. Details next. And as we go to break, a look at some of the big movers of the day, including Walgreens, United Health, and Goldman Sachs. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI is upgrading Bausch & Lomb to a buy. The firm cites potential for the iCompany sale following a report that TPG and Blackstone have teamed up to work on a joint bid for the firm. Next up, Goldman Sachs giving Etsy a DI don't. The analyst there downgrading the online retailer to a sell, saying that he prefers firms less exposed to discretionary spending. You can see shares pretty resilient, all things considered. Finally, we have Apple getting a tactical outperform call at Evercore. The analysts say that bearish sentiment on the iPhone maker is overdone and expects government stimulus to boost smartphone demand in China. Apple, of course, reports earnings on October 31st, Matt. Very spooky.
Wow, fiscal help out of China for Apple. Let's turn now to the latest AI news. This does not involve Apple. Bloomberg sources say Biden administration officials have discussed capping sales of advanced AI chips from NVIDIA and other American companies on a country-specific basis. Let's discuss the implications with Bloomberg Intelligence senior analyst Mandeep Singh. First of all, don't we already do that? I mean, we don't allow NVIDIA, at least technically, to sell its biggest or most advanced AI chips to China.
Yeah, even though there are restrictions in place to not ship the most advanced chips, China is still over 10 billion in sales for a company like NVIDIA because they still ship a lot of their lower versions of the chip. They are complying with all the restrictions. But look, with all these companies, China is still the dominant market. When you look outside the hyperscalers in the US, there the companies are still spending their money on training the LLMs. They're spending a lot of CapEx dollars. And for a company like NVIDIA, once you go outside the hyperscalers, they have to look at sovereigns. So this is where the restrictions come into play, because sovereigns is a low double-digit market for NVIDIA now. And you have to ask yourself, who are the sovereign buyers? Is it Singapore? Is it Middle East? Beyond China? And I think that's where the government is targeting, because there is a diversion aspect to some of the chips, advanced chips, indirectly reaching China, even though they're... I mean, look, it's so hard to control, because if you build a cluster in Singapore, how do you make sure that that cluster is used just by companies within the Singapore region? You could be domiciled in China and still using a data center in Singapore for training your LLM.
Right, although, I mean, the New York Times had a great piece a couple of weeks ago about the fact that there are Chinese companies and military operations in China that are still getting those chips, and NVIDIA really isn't putting up much of a fight.
Well, again, that's where, you know, all the sovereign buyers and they've quantified how big the sovereign kind of buyers are in terms of sales for NVIDIA chips. You have to ask yourself, what are the companies outside of US and China, the hyperscalers, who are training their own LLMs, knowing that LLMs require north of 300, 400 million for one training run, and you have to keep upgrading these chips. So the largest internet companies are domiciled in these two regions, and they are the ones who are training their own LLMs at this point of time.
Well, Mandeep, I'm curious to hear your perspective on the balance of risks here, because, you know, you think about the U.S. position, they're worried about national security. I get that. But at the same time, if you sort of cap NVIDIA here, don't they want NVIDIA to be dominant, to be leading the industry, or are they concerned at all that someone else could come in to fill that void?
Well, so NVIDIA clearly has a lead when it comes to the chip making side, but I think China is building their own chips. We have heard about Huawei's effort to make their own server chips as well. And look, when it comes to LLMs, that's where the race is. Who has the best large language model, whether it's a company based in US or is it domiciled in China? Because that's what everyone is striving for. The latest and greatest when it comes to the large language models and what it can do in terms of intelligence and reasoning. And that's the end goal. Chips is the way you get there, because that's how you're training the LLM. But the end goal is who has the best large language model for all the applications that are getting deployed.
And of course, we're talking about NVIDIA, but just quickly here, I mean, AMD is also part of this report. And of course, AMD is down more mightily currently in the market than NVIDIA is, down about 3%. What does this mean for an AMD versus an NVIDIA, which is so dominant? Yeah,
look, there is more demand than supply for NVIDIA chips. We know that. And that's why, you know, they keep beating and raising their numbers. So even if China is not the incremental buyer, there's some other incremental buyer for NVIDIA. But for AMD, which is a distant second, China would have been a big buyer had it not been for the restrictions, because the incremental buyers are not, the list is not that big as it is for NVIDIA. So clearly, I think China market being blocked or more restrictions does affect AMD in a big way because they are looking to ramp up that business that NVIDIA already is doing $100 billion in data center revenue.
Yeah, and it's amazing. AMD shares, as we just showed, only up about 8.5% year to date, trailing the broader market in a big way. Mandeep Singh, always great to see you. That, of course, is Mandeep Singh of Bloomberg Intelligence. Now, coming up, it's the segment we've all been waiting for. We're going to talk about Boeing's bid to boost its balance sheet as it faces a second month of strikes. More on that next. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's take a look at the stock market. About 22 minutes into the trading day, green on the screen just slightly, but green nonetheless. The S&P 500, the Nasdaq 100 currently higher by about 0.1%. The Russell 2000 also mildly getting in on the action, of course, shaking off its pre-market losses, currently higher by about also 0.1% when it comes to the small caps. Let's talk about Boeing, though. Go on.
Did you see Jonathan Gollub's new price target for the S&P 500?
He raised it, I heard.
To 6,400.
That is over the next 12 months?
It had been, I was just thinking about this because yesterday you were talking with somebody and you said, hey, your price target is 58.50.
I did say, that was Larry Adam.
Exactly, and now we're at 58.53. So Gollub's target was, I think, 58.50 as well, exactly. And he's now raised it to 6,400.
You know, I said at the start that you could sketch a bear case. I guess Jonathan Gollub heard that and said, no.
No bear case.
Let's talk about Boeing, though, because you could sketch a bear case about Boeing. It's planning to raise as much as $25 billion. This is the troubled plane maker. It looks to shore up financing as it tries to withstand a prolonged strike. Joining us now, I am thrilled to say we have Bloomberg's Boston bureau chief, Brooke Sutherland. She's the author of the Industrial Strength newsletter. So we knew something like this was coming. Of course, you had plenty in the analyst community saying that they need to do some sort of equity raise here. Talk us through this $25 billion shelf, though, and what we know so far.
Sure. So a shelf filing is really sort of a precursor to raising any kind of equity, and it can be a mix, actually, of stocks or bonds. Although in Boeing's case, they're more likely to issue, lean heavily on stock issuance just because their debt is sort of teetering at that precipice of junk, and they're very much trying to avoid that. You had both S&P and Moody's now warning that they are reviewing Boeing's credit for a potential downgrade in junk. That would make the company the biggest so-called fallen angel ever, really. And it would obviously increase Boeing's cost at a time that they can ill afford more expenses. So this was not unexpected, and this is really sort of a lifeline for them and something that they need to consider, not just to get through this current cash crunch that they're facing while they deal with a labor strike and slower production of the 737 MAX before that because of the issue that happened back in January with that blown out door and extra scrutiny from the FAA. But then also looking forward, Boeing needs to also think about the future. They need to think about a clean sheet replacement for that 737 aircraft eventually if they want to continue to compete with Airbus. And so for Boeing to think about that future, to have that future, they really do need to be thinking about some sort of financial lifeline here.
But of course, they can't fail, right, Brooke? Because airlines want to have more than one plane maker, and the U.S. also wants to have its own. Plus, there's only one other, really.
Absolutely. And I mean, the reason why we're sort of in this position to some extent is because there was so much consolidation in the aerospace manufacturing industry in the U.S. And you are right. Boeing is really the only viable maker of large aircraft in the U.S. It is a national champion. It is a major defense contractor. So it is not an option for this company to fail. And the U.S. government cannot let that happen. So there is that backstop there. But that, there are shades of in between there, between a company falling into junk status and getting to the point where we're talking about too big to fail.
All right, Brooke, thanks very much. Brooke Sutherland there talking about the Boeing story that we will continue to cover, possibly
Closely.
From here to eternity.
Yeah,
right?
I mean, it is amazing. I think it's a great point that there's really only two. You really only have Boeing and Airbus, and this is an industry where it just seems impossible to disrupt. I know that, there's been some mutterings about maybe Embraer will try to step into that space, but it's really hard, Matt.
I mean, the other interesting thing is they've filed a shelf for 25 billion. They don't have to raise that much,
Right.
So you could still see a 15 billion.
But wouldn't it be
raising.
cool if they did all 25 billion?
It would. Coming up in the next hour, we're going to give you more on equity valuations and earnings expectations with Cameron Dawson of Newedge Wealth. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment, and coming up, a profit beat for Johnson & Johnson as it expands into cancer care. We'll speak to the company's CFO, Joe Wolk, in our C-Suite later this hour. It's T-minus 3 weeks until Election Day as well. We'll take you to the Bloomberg City Lab Summit in Mexico City. We're going to talk about immigration and border security with the mayor of San Antonio, and both candidates are hitting swing states hard. We'll get to the latest on the road with the White House as Bloomberg sits down with Donald Trump later this afternoon, 12 p.m. Don't want to miss it. Let's get to the market check. We'll see if I can get my words out, because you take a look at the markets.
It wasn't an easy roundup.
Oh boy, yeah.
To your credit.
A lot of syllables in that one. It's the S&P 500. This is pretty simple because not that much is happening. The S&P 500 currently unchanged, but still the arrow is green. And Matt, as we've been pointing out, that would still be a record if we held that gain. You take a look at the NASDAQ 100, a little bit more of a buffer to the upside there, but still about 0.1% on your big tech index. Meanwhile,
so weird to me.
Yeah, what's that?
You know, because we had such big beats by the banks in terms of trading, and then huge moves like Schwab, for example, right? All to the upside.
But have you not been listening to me? That's just 13% of the market, the financials. And then you take a look into the financial sector, only like 33% of it is actually the big banks. So pretty small overall when you think about this broader market that's just dominated by the tech names, and it's pretty quiet in the tech space.
But the tech names are doing well as well.
Yeah.
It's all energy that's pulling us down.
You know, maybe we should talk to Cam Dawson about it.
Let's bring her in.
All right, do it.
Cameron Dawson joins us right now, Chief Investment Officer at Newedge Wealth. Cameron, it's just a weird market because although I know that the financials are only 13% of the S&P 500, the names, you know, Goldman Sachs, Bank America, Citi, all doing great in terms of trading revenue, and that broadens out then to a Schwab, which is not a big bank, but still in the financials. I mean, I would think that underpins a rally. Don't you need the financials in order to have a healthy rally in these markets?
It's a great adage that you don't need financials necessarily to lead in a bull market, but you certainly don't want them lagging. And I think that the message from the financials this morning is one that the U.S. economy remains resilient, because even beyond the trading revenue, if you listen to the commentary that they had about the consumer, they're saying that the consumer remains strong, that there is resilience under the surface, that asset balances are really healthy, and that spending remains healthy. And that's a message that this market wants and needs to hear, to say that there's not signs that the consumer or the labor market is falling off a cliff. And it supports this notion that you could continue to see EPS growth, mostly compared to forecasts, which are pretty aggressive into 2025, but it supports the notion that those forecasts are somewhat achievable given this backdrop of resilient growth.
I've been thinking about this broadening out that we keep talking about. It's been very hot and cold. It's sort of a nice to have rather than a need to have. The need to have feels like the big tech names. So let's talk about them a little bit, because you remember the narrative around big tech last earnings season was that investors are getting a little bit impatient, that they want to see that return on investment when it comes to the AI spend. What do you think the narrative this time around will be, Cameron?
Well, it could be something as simple as the fact that typically we see cyclicals perform better starting in October through about April. And if you think about tech as a cyclical sector, mostly with semiconductors, which have been the key leadership in this move higher in tech over the last couple of weeks, it makes sense to see some signs of life in those cyclical areas. That's being confirmed by other cyclical places like financials, like the industrials, like the materials. So it could be less about what's actually going on with these companies and the fact that there's just this seasonality of returns. The one thing we would watch really closely with tech, mostly going into 25, is that there's a big earnings acceleration that is already baked into tech EPS forecasts for next year. The street has earnings going from 17% this year to 25% next year. That could be a challenge given the fact that NVIDIA, one of the largest weights in the tech sector, is supposed to be decelerating its earnings from 140% to 40%. So there's a really high bar for tech earnings in 2025. You have crowded positioning, you have fulsome valuations. All could mean that maybe the pace of return for tech starts to slow a bit into next year.
Yeah, we're expecting, the pace of big, Magnificent Seven earnings to slow as the S&P 493 earnings accelerate. We had been in an earnings recession until the last quarter. But Mike Wilson was on Bloomberg Radio this morning telling Nathan Hager that this whole recent rally has been driven by multiple expansion. It's not actually really a gain in earnings growth. What do you think about that idea and the fact that it's really continues to be the fiscal boost that's helping earnings rise at all?
I think that's such an important observation because, in fact, in the last couple of months, you've actually seen a slight trimming to 2025 estimates. They've gone down by about 1.5% over the last couple of months, even though you've seen this huge valuation expansion. So the challenge we have is that as you're trading at 22 times earnings, you've never traded higher except for two other periods over the last 30 years, the peak of the tech bubble and the peak of the COVID policy bubble in 2020. So that is just an extraordinarily high bar to jump over as we turn the calendar into 25. On the fiscal point, I think that's also really important as well, is that if we take a step back and appreciate this backdrop for risk assets, looking at the fact that you have fiscal support on a deficit level that is as if we're in a crisis, but we're not in a crisis. You have now monetary policy that is set to be the deepest non-recessionary Fed cutting cycle of the last 40 years, all into a strong growth environment, all suggest that no wonder risk assets are trading at such high valuations. No wonder you have equities at 22 times and credit spreads back to 2021 tights, because this is an extraordinarily unique backdrop of supportive fiscal, supportive monetary into a strong economy. But as we know the old poem that nothing gold can stay, it's the question of where do you go from here?
Well, let's bring that cross-asset. I mean, you mentioned gold. I want to talk about the bond market because I'm taking a look at your notes, and you write that rapidly rising long-end yields, that is one of the factors that could pressure those high valuations. You take a look at where we are on the 10-year, for example. We're trading around 4%. Is there a level to keep in mind that would really be painful, or is this truly about the rate of change?
Look at 4.15% on the 10-year yield. That's really important resistance. It's your 200-day moving average. Right now, 10-year yields are overbought in technically a downtrend in a very big week for economic data. The key reason why you have seen 10-year yields rise is two big things. The first one is economic surprises, meaning as economic data has come in better than expected, that's provided a boost to 10-year yields over the last few weeks. The other thing that 10-year yields have been correlated to is Trump's odds of winning in the November election. So when you put those two things together, you've seen this boost to yields, but now you're overbought into resistance with a week where we're getting something like retail sales, which if it comes in hot, maybe we break through that resistance at 4.15. If it comes in soft, then we likely roll over and we reduce that risk that 10-year yields moving higher could challenge equities.
All right, 4.15% at the 10-year. We are at 4.05% right now. Cameron Dawson, it is always great to see you. That, of course, is Cameron Dawson of Newedge Wealth. Meanwhile, let's get a look at stocks moving this hour, including United Health having a hideous day. Here's Abigail Doolittle.
United Health may be having a hideous day, but Walgreens is having a great day. In fact, the last time that I used the SINS function on the Bloomberg terminal, the best day going back to 2008. This after the one part of their view is better than had been expected. That's the 2025 sales view. It beat estimates. In addition, they gave more color on the stores that they will be closing. They took a $3 billion loss on tax charges and a write-down. Overall, though, investors have a little bit of relief for this beleaguered drugstore and retailer. Turning now to United Health, and if we take a look at some of the other big healthcare companies, yes, we have a sea of pain here. United Health Group, that's the worst day, down 9%. 0.2% since 2020 after the high end of their view missed. Medical costs higher than what folks expected, investors and analysts, and again, weighing on the whole space. And then finally, to end on a rally that beats all rallies, really, let's take a look at the shares of Trump Media and Technology Group, up 143% since not even a month ago, Katie. This is really pretty incredible, and again, a way of the market saying that they think that the former president may be more likely to win in November. We don't know that's the case, but this again is a pretty spectacular rally.
All right, Abigail Doolittle, thank you so much. A lot going on the single stock level today. Let's also talk about Apple really briefly. Currently up about 2.6%. That's good for an all-time high intraday. Of course, we'll see if those gains hold. We know that it got an tactical outperform rating over at Evercore earlier today. It reports on October 31st on Halloween, Apple does. So we'll see, of course, what that does for this momentum. I know, it is spooky season.
You know, the SINS function that Abigail referenced is one of my favorites, but it's for internal use only.
I mean, you got to.
So clients cannot access it.
You got to keep some things sacred. But Apple, of course, having a great day. Not enough to lift the broader markets. We'll continue to talk about that push and pull. But coming up, we're live from the Bloomberg City Lab conference in Mexico City. We'll talk housing, immigration, and border security with the mayor of San Antonio, Texas, next. This is Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. German automakers are struggling to offer EVs that meet the needs of customers in its biggest market, which is China. Traditional automakers are falling behind their Chinese rivals when it comes to advancing the technology in their EVs. If the trend continues, Volkswagen, Mercedes, and BMW stand to lose out on their $38 billion investment. And a diplomatic dispute between Canada and India is escalating. Canadian PM Justin Trudeau is accusing Indian diplomats of backing a pattern of criminal harassment and violence against Canadians. India and Canada have both expelled each other's top diplomats over the assassination of a Sikh separatist on Canadian soil. The fight marks a new low in an historically cordial relationship. And immigration is one of the most important issues for voters in the upcoming presidential election. And San Antonio, Texas is at the forefront of the debate, often acting as a migration hub where authorities send people en route to their final destination. Joining us now for more on that from the Bloomberg City Lab Summit in Mexico City is the mayor of San Antonio, Ron Nirenberg. Mr. Mayor, great to have some time with you. I was looking at some charts about the flow of migrants over the southwest border from the CBP. And indeed, we've seen a spike to the highest levels of immigration across that area in American history, at least in the history of the United States of America. How have you dealt with that in San Antonio? How have the people of San Antonio dealt with that influx of immigration?
Sure. Well, good morning, and thank you for having me. I think the first thing I would say is contextualize this. This is not unique to the U.S. southern border. This is happening all across the world. More displaced people in this period of time, 114 million people worldwide, more since World War II. So what's happening at the southern border is not unique. What is unique, however, is the political and legislative paralysis within our political system in the United States. How we have handled that at the local level, since we don't deal with solutions to immigration policy, is that we've had cooperation from the Biden and Harris administration to provide resources so that we can do two things. We can make sure that we continue to uphold our values as a nation, but we also deal with safety and resources in a way that allows people to move on to their next destination while protecting public safety. It has been a successful effort, and since that period of time when President Biden issued his executive orders, we've seen about a 90% decrease in traffic through our migrant resource center. So it works when Congress puts solutions together. If they yield to the politics of Donald Trump and we're left with no solutions, it's incumbent upon presidential leadership, and that's exactly what we've seen with President Biden.
Mr. Mayor, I imagine you have to uphold the law. do you then, when you find someone in this country illegally, work with the government to send that person back to his or her home country, or do you move that person along in the system somehow? How do you sort of stop the breaking of the law in that situation?
That's exactly right. We cooperate with local law enforcement, with federal authorities, and so folks who are in our city have been vetted and have been given asylum hearing dates, some cases years from now, which is part of the problem when we don't have legislative solutions that were clearly laid out in a bipartisan border bill that Trump unilaterally killed by calling his favorite senators. So there are solutions to this. At the local level, however, we work with federal authorities to make sure that we have the resources to treat people with compassion, but also protect public safety and maintain public order.
And I want to bring the labor market into this conversation. We know, of course, at a federal level that it's still very strong, but there was an interesting story from Texas Monthly recently, which actually found that Texas has 80 workers for every 100 open jobs, and that construction jobs in particular have a high degree of job openings right now. And I'm curious, I mean, how has immigration impacted that? Have you been able to fill some of those job openings with migrants?
Well, San Antonio is a international city. We are a city that has been multicultural and has roughly a 15% foreign-born population. So, you know, immigrants are part of our labor force, regardless of the career field, in high-skilled positions and in all kinds of markets. So, of course, immigrants are part of our construction workforce as well, same as residents of San Antonio. And we know in this period of time when there's an extensive amount of capital investment, a lot of construction going on, there is a need for construction workers, there is a need for manufacturing workers, and we've put a lot of our own resources, including resources from Vice President Harris and President Biden, to help us continue to build the skills in our workforce to make sure that we can fill those jobs.
Well, I'm curious, I mean, how do you, sort of building on what Matt was asking about following the law here, how do you ensure that there's going to be fair wages, safe working conditions when workers are both documented and undocumented?
Well, every single job is obviously regulated, and unfortunately we can't change Texas law, which unfortunately hasn't changed with regard to minimum wage in 20 some odd years. But, you know, we make sure that we work with all industries to ensure that folks are, you know, gainfully employed, but are also that employers are treating their employees correctly, and also, you know, they're properly working with all of the laws and regulations in the area.
I want to ask about housing prices. I was looking at the Freddie Mac house price index for San Antonio, and indeed you see a spike in home prices right as soon as you see a spike in immigration at the start of the Biden administration. The two seem very correlated. How are you doing at keeping housing affordable for your residents?
Well, I'm not going to slip into that kind of correlation equals causation. The idea that migration has caused the spike in housing prices is absolutely absurd. What we've seen is a tightening of the supply chains. We've seen a tightening of the labor markets. This is a worldwide phenomenon. But we also know that housing prices are going up because people are coming to our city from California, from Illinois, from Texas itself. We're a great city to live in, and that's made us very desirable. We've had a strategic housing implementation plan in place that we've been implementing to make sure that the housing market is stable and it's healthy. Of course, housing costs have gone up roughly 25% over the last 4 or 5 years. But relative to some of our peer cities, we're doing a good job in making sure that there's a healthy supply to the demand in housing. And that comes in all forms and types. We know we need more rental housing for young professionals and students, but we also need home ownership options for people who are moving into their professional prime careers and also retiring in our city. But we have a good, healthy housing market in San Antonio. Of course, we're in the midst of a housing crisis worldwide. We're doing what we can to make sure it continues to be sustainable and healthy.
All right, Mr. Mayor, thanks very much for your time. Really appreciate it. Mayor of San Antonio, Ron Nirenberg there. In less than 2 hours, A quick programming note, Bloomberg editor-in-chief John Micklethwaite will be sitting down with former president and current presidential candidate Donald Trump. That's an interview at noon New York time that you don't want to miss. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, EV chipmaker Wolfspeed is set to win $750 million in U.S. government grants and another $750 million in financing led by Apollo to support its factory expansion. It's a welcome shot in the arm for a company that last reported a profit 10 years ago, and you can see shares currently up about 29%. Next up, Google redesigning its shopping website to better compete with Amazon. A new homepage will display a personalized feed of products, reviews, and auto-playing video shorts from YouTube. And finally, we have Duke Energy getting a boost after Mizuho upgraded the utility to a buy. The firm says that the recent hurricane-related sell-off is, quote, a great buying opportunity. And there you have it, shares up about 2%. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, let's get a check on these markets. About an hour into the U.S. trading day, really interesting setup, of course, as we've been talking about. Now the S&P 500 down a little bit. The NASDAQ 100 down 0.3%, even though you have Apple shares trading at an all-time high right now. At the same time, you have NVIDIA a little bit lower. And you think about the math there, of course, NVIDIA a weight on that market. Meanwhile, a rally in the bond market. 10-year yields currently lower by about 5 basis points. We're still above 4%, but we're not quite as close to that 4.15% level that Cam Dawson was warning us about. But all in all, a pretty quiet market after that big run-up that we've seen. Now coming up, Johnson & Johnson shares surging after reporting strong sales of their cancer drug. We'll speak with the company's CFO, Joe Wolk, coming up next. This is Bloomberg. Well, Johnson & Johnson out with their third quarter results this morning and profit beating analyst estimates. Bloomberg's Abigail Doolittle has a closer look.
Yes, profits of $2.42 and adjusted earnings per share, Katie, beat by about 12%. Shares responding well, up more than 2% on the day. They also beat relative to sales, putting up almost $22.5 billion in sales for the quarter. That's 1.4% better. Their cancer drug sales really surging. And then relative to the update to the view, the sales view is a little bit better than had been expected. The earnings a little bit lighter as though the V-Wave deal weighs to some extent. As for the bigger picture of how Johnson & Johnson and Kenvue, the spin-out, are doing relative to the S&P 500 over the last year. The S&P 500 is clearly outperforming, up 35%, but you can see both Johnson & Johnson and Kenvue moving in the right direction, both up over the last year, Katie.
All right, Abigail Doolittle, thank you for that setup. And let's keep the conversation going now with Johnson & Johnson CFO Joe Wolk joining us again. Joe, it's great to speak with you, and feels like for the last several quarters I've asked you what's going to happen when Stelara loses that exclusivity. We know that biosimilars are expected in January, and then you come out with a big beat when it comes to Darzalex. Of course, that is one of your cancer medications. Is that enough to offset, of course, Stelara losing that exclusivity?
Good morning, Katie. It's a pleasure to be here with you today, and thanks for your interest in Johnson & Johnson. It's part of the equation in terms of how we're going to overcome Stelara loss of exclusivity next year. In addition to the great performance out of Darzalex, which is actually gaining share as approvals over the last few years have moved that up in the course of treatment. So we're now hitting newly diagnosed patients where maybe 3 or 4 years ago it was more for third and fourth line setting. But we've got a stable of products products that are coming, and we had 5 approvals in the quarter addressing serious disease states like bladder cancer, lung cancer, multiple myeloma, as well as inflammatory disease such as ulcerative colitis. That gives us 16 approvals this year across the globe for either new products or new indications. That really positions us extremely well, in addition to the great performance of the Darzalex, where we'll be able to overcome the Stelara loss of exclusivity. There's only been one company that has had a growth in the year in which there's been a major product be subject to loss of exclusivity, and that was Johnson & Johnson back in 2018 with Remicade. We plan to do the same thing in 2025.
And let's talk a little bit about some of the specific numbers here, because you beat by 23 cents today. You had a 10-cent raise. So, I mean, 23 cents, obviously more than 10 cents there. When it comes to that 10 cents raise, I mean, the fact that it's maybe a little bit milder relative to some expectations, does that relate to Stelara destocking, for example, or is that some other component?
No, it's actually, there's a good news story there. So when you take in foreign currency change, the 23 is probably more equivalent to a 15-cent raise overall in the longer-term outlook. But the differential, and it's a really good question on your part, the differential is we intend to invest in the fourth quarter to continue accelerating this robust pipeline that we have. We did benefit in the quarter from a monetization of a royalty agreement we had. Somebody bought out the royalty we had rights to for a liver drug. We're going to take that unexpected income and move that towards investment for R&D. We're very proud while we were able to improve operating margins, it wasn't at the expense of our R&D investment. In fact, when you take out the acquisition costs that were included in the quarter, and by the way, the quarter was an all-time high for R&D investment, but even when you take out that one-time payment, we still, on a percent to sales basis, invested more heavily than we did last year at this time. So we continue to prioritize that next available dollar towards that innovation investment that will not only project well for the coming quarters, but quite frankly, the coming years.
Joe, as you said, no other company has ever grown revenue for a drug that's gone off patent other than Johnson & Johnson. And you expect to do that with Stelara as well next year. How do you plan on achieving that? I mean, do you have a playbook from last time? Is it about marketing?
Yeah.
What's the solution?
Yeah, so with all due respect to my commercial colleagues who are fantastic at what they do, it really is about planning for the future. And Matt, you've heard us say before, we think in terms of not the next 2 quarters, but really the next 2 decades. And when you can invest in innovation, it puts you in a very distinct advantage. We're fortunate in our industry in that we don't wake up one morning and say, oh my gosh, we've lost a patent on something. We've got years to plan. So when we saw Stelara loss of exclusivity on the horizon, we started investing in this pipeline in 2017, 2018. So you need that kind of time horizon in order to plan. And we have we have more robust portfolio today in the pipeline than we did when we encountered the Remicade loss of exclusivity.
I wonder about, you've obviously spun off your consumer health business. GlaxoSmithKline did as well. Sanofi wants to do that, which tells me that the pharma business doesn't necessarily sit well under the same roof as other businesses. And yet, you have devices, and you continue to add to that business with deals. Do you see those 2 units staying together?
We do, Matt. If you think about where our long-term success will be, it's going to be by having a top-tier pharmaceutical business that investors prefer and a top-tier medical technology company that investors prefer. But we're starting to see kind of the convergence of both segments coming together. We've got a great offering now. It's a targeted release system for bladder cancer drugs. It's a pretzel-like device that sits on the bladder. There's less side effects, and it's actually much more efficacious. 84% overall survival or response rate in some recent studies. That is using a device technology to apply the cancer drug to the tumor itself that sits on top of the bladder. Those are the type of technologies that we think Johnson & Johnson is uniquely positioned to benefit from down the road, not just for patients, but for our business. But make no mistake about it, that is not where we're looking to be successful or where our success will reside in the next 5 or 10 years. It's making sure we continue to innovate in pharmaceuticals, innovating in medical technology.
Let's talk a little bit more about deals, of course, because you've made several of them over the past few years. You told Bloomberg in an interview that you're still seeking those smaller tuck-in deals that offer good value. You're open to larger acquisitions. I'd love to get just a little bit more detail here. I mean, what is the anatomy of what would be an attractive deal for you at this point? And would it be in pharma or devices, for example?
Yeah, and that's kind of the nice part of the answer is it depends, right? So when we look at kind of the criteria, we want to make sure there's a strategic purpose, a strategic fit to our business. So why is that asset worth more to us than it may be where it currently resides? Do we have a scientific expertise, a commercial capability? Maybe it is global reach. And if that standard is met, then we go on to the remaining 20% of the discussion with our board, and that's, does it create value and compensate shareholders for the risk that we're bearing on their behalf? You know, we've deployed about $36 billion in capital over the last 20 months. Two of those deals required about $30 billion of that capital. Where investors get most excited is actually the balance from 30 to 36 billion, whereby we had 75 deals in that mix. That's where we have the opportunity to create the greatest value. We're not adverse to doing larger scale deals, as we've obviously demonstrated, but those tuck-ins work really well, especially when we have clinical expertise that can kind of see not just around the first corner, but a couple corners to figure out what best solutions may reside for patients down the road.
And Joe, we only have 2 minutes left with you, and we're going to try really hard to squeeze in 2 questions. So here we go. Let's talk about talc, for example, because you've, of course, this has been a long-running thing trying to address that litigation. We know that a federal bankruptcy judge in Texas said that he'll keep that handling in his own court. Of course, New Jersey, you haven't had such good luck there when it comes to the appeals court there. Do you think that you'll fare better in Texas and maybe finally get this wrapped up?
Yeah, we do. If you think about the bankruptcy law we're trying to target and hone in on, which precedent law would suggest should stay intact, it's providing maximum recovery for claimants on an otherwise, while preserving an otherwise viable business. That is exactly what we're trying to do with this offer. And in fact, this offer is supported by 83% of the claimants. We are providing them with their best recourse opportunity. If you just took the number of cases alone, it would take 2,500 years to adjudicate in the courts. There are some holdouts, but those holdouts personally gain financially by holding out. So we think this is a good combination. Make no mistake, while we want this responsibly behind us, J&J is still in a position with $14 billion of free cash flow to continue to invest for the long term, and these payouts will happen over a number of years.
I just want to ask about the election. Obviously, 3 weeks from today, we're going to talk to Donald Trump today at noon. Does it matter to Johnson & Johnson with regards to IRA changes, potentially?
So, Matt, we've been around for about 138 years, 23 different administrations. We're going to continue, whoever wins, to work on science that changes the game for healthcare. And Johnson & Johnson, quite frankly, doesn't have a vote, but the tens of thousands of employees that work for Johnson & Johnson based in the U.S. do. Some of the things we consider, though, when we look at what's important to our business is tax policy. We do think that the 21% is the fair share rate that exists today. We've been able to invest more in our business and create more jobs in the U.S. The other piece, I would say, is over-regulation or misguided regulation. We think the Inflation Reduction Act will limit innovation. There'll be a scaling back of the $500 billion that the industry invests on an annual basis to bring better science for better healthcare and better living.
All right. Joe, thanks so much for your time. Appreciate you joining us. Johnson & Johnson Chief Financial Officer Joe Wolk talking to us about the fair share rate. They believe it's about 21%. As we know, Harris wants to raise that to 28%. Donald Trump said he's going to cut that to 15%. We'll hear more about that from the man himself. Donald Trump's going to sit down with our editor-in-chief, John Micklethwaite, at noon today in an interview that you don't want to miss. Now, in terms of market moves today, ASML shares have been decimated after third quarter bookings missed estimates. You can see they're down more than 10%, almost 15% right now. Trading in ASML is halted, but we'll continue to bring you headlines as they cross. And as we go to break, let's take a look at some of the bigger movers of the day, including Walgreens. We see Walgreens has taken a big hit as well. A big hit to the upside. 14% is the gain there. United Health down 7%. NVIDIA off 6, and that takes away 15 points from the S&P 500 roughly. Goldman Sachs now down after a blowout quarter for its traders in Q3. This is Bloomberg.
Well, it's time now for our daily Wall Street Week conversation. And as demand for electricity continues to rise, so does the necessity for cleaner energy sources. David Weston speaks with Mothers for Nuclear co-founder Heather Hoff about the need for nuclear power.
Yeah, I think safety is a little bit of a tricky word, and maybe we need to talk about it differently, more in terms of risk. And it turns out that a lot of things about nuclear sound scary, but that doesn't mean that they're dangerous. So I think that was something that took me a long time to learn. And now that I've been working in nuclear for so long, there's still a lot of things that I know if we said them out loud would sound scary to other people. But the actual risk to human health or the planet is really low, and it's actually the safest energy source that there is. So that's surprising to a lot of people.
Were we mistaken on the risk factor, or has that evolved? Has the technology evolved?
I think when we talk about risk, it's also important to ask, what is the actual impact when something happens? And so everyone kind of knows the big three things that have happened in nuclear: 3 Mile Island, Chernobyl, and Fukushima. And when we go back and we look at those events and say, what was the impact to human health, our environment, the planet, it's pretty minimal. And even some of the impacts that we did feel were caused by our own overreaction to those incidents. So I like to say that, fear of nuclear is dangerous, but nuclear itself isn't.
So we've heard now that 3 Mile Island has plans to reopen. What was your reaction when you heard that?
Yeah, oh my gosh, it's so exciting, and kind of just a headline, that's really going to get a lot of attention. I think it's symbolic in a lot of ways, similar to the way that my power plant, Diablo Canyon, choosing to relicense and run for longer than expected is also symbolic, because Diablo Canyon was home to some of the largest anti-nuclear rallies in the country. So I think both of those cases show that nuclear is valued, that we need more clean electricity, that other technologies, we've been rolling those out for decades, and we're making progress, but it's not fast enough, and we really need powerful nuclear energy to help us meet our clean energy goals.
What about the issues surrounding nuclear waste, at least with fission?
So nuclear waste, some of us like to say it's only waste if we waste it. There are great technologies that we could use to recycle more of our used fuel. So I hope we see that eventually. And I also think that, again, it's a fear thing. Nuclear waste sounds really scary. Is it actually dangerous? Not really. We're not going to go eat it. That would be bad for you. But you can't really even eat it. You can't get to it. It's in a concrete cask. And it's basically, it's very concentrated energy still, but it just sits there and it doesn't hurt anyone or anything. And so I think that fear is a little bit overblown, and that when people see how we store used fuel, it really relieves a lot of that misinformation in their minds.
And that was the Mothers for Nuclear co-founder Heather Hoff speaking with David Weston. David joins us now. Really fascinating that I had this philosophy professor at Denison, Ron Santoni, and he had the same kind of look, like the peace medallion and the T-shirt and the jeans jacket. But she's going the other way that Ron used to go. So she's really worked this out in a marketing sense, I think.
I think you see the passion a little bit there of the convert, because she started out dead set against nuclear energy, because she'd heard about 3 Mile Island, she'd heard about Chernobyl. She said, no way, no how. But when she came out of school with a degree in chemical engineering, it was the job she could get in her community. And so she went to work at a nuclear plant, and it really changed her mind. And then ultimately, she co-founded, as we say, Mothers for Nuclear, which is quite a turnaround.
Yeah, I am tickled that that group exists because I didn't know that, Mothers for Nuclear. And it was interesting to hear her talk about still that there's this perception problem, that nuclear waste, for example, sounds very scary. I have to imagine that they're trying to address, of course, that reputation problem.
Well, and there are a couple of aspects of it. There's new technology. We actually talked to Dan Brouillette. Remember, he was the energy secretary under President Trump about this. And he said there are new technologies now to use some of that waste, both in breeder reactors, but also for healthcare purposes. Basically the radioactive material. But also one of the things that Heather said was if you took all the nuclear waste that had been generated since the beginning of time in fission plants, it would occupy one Walmart. That's how big it is. It's not that big, it can be handled. So they think we can handle the problems. And always the question is, as opposed to what? I mean, because it doesn't generate any greenhouse gases. What's the alternative? And what's the damage and the risk associated with that?
She did say not to eat it, though. I
Yeah,
heard her
that's
say
a
that.
good admonition. Yeah, exactly.
Don't ingest it, David
You
Weston.
know why they don't launch it into space?
Tell me.
Because it would be very bad if the space shuttle then blew up and it came raining down back upon us.
I could see that situation not being one that you would want. That probably wouldn't help, of course, the perception problem. David Weston, looking forward to that interview, of course. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, a quick check on these markets because we have a turnaround on our hand to the downside. The S&P 500 currently hovering near its session lows, down about 0.3%. The tug of war, you have Apple up about 1.7% at an all-time high. You have Nvidia down over 4%. Nvidia, clearly the weight on this market. We'll continue to track it all. This is Bloomberg.
We are counting down to the U.S. election now, exactly 3 weeks away. The race is becoming a sprint. Let's catch up with Bloomberg's senior Washington correspondent, Saleha Mohsin, for the latest on the candidates. Saleha, it seems like a day doesn't go by without a new tax giveaway from Donald Trump, a promise thereof. But yesterday, something different. He had people fainting at his rally and then started to dance, playing, I guess, Pavarotti's Ave Maria. What happened?
Yeah, the Secret Service has now said that Trump has to hold indoor rallies and big events. And so the group was inside. It was lots and lots and lots of people. It got really hot in there. You end up having to wait a long time for a president or a former president to come out. And someone fainted, then a second person fainted, and Trump read the room and realized in this moment, we're not going to talk about anything serious. I'm going to just engage with my supporters here and dance with them. So he left them a little bit happier, it seems, but they did leave early, according to some reports. It was getting really, really hot in there.
Yeah, of course, those security measures mean that you can't just open a door and let the air in. They also played YMCA in addition to
True.
We did watch that at 6 in the morning. So I am curious. I mean, you have both of these candidates on the trail. Like Matt said, we have a sprint to the finish right now. And one of the big topics is the economy. We know that Donald Trump is sitting down with our editor-in-chief in just about an hour's time, and have to imagine that'll be a big topic of conversation.
Yeah, this is more interesting to me than what Trump did yesterday. I'm really looking forward to having our editor-in-chief interview Donald Trump about economic policy, about foreign policy. I think we should expect some smart follow-up questions, and we should be hearing maybe more on tax policy. I don't know what more tax giveaways are left, but just generally how his policies that he has sketched out so far could affect the rest of the world's growth, the U.S.'s growth, and maybe even the growth of our budget deficit.
Well, great preview. Of course, that is Saleha Mohsin joining us from D.C. And like we just said, in about 1 hour's time, Bloomberg editor-in-chief John Micklethwait will be sitting down with Donald Trump. That's at 12 p.m. at New York time, so don't go anywhere. Meanwhile, let's take a look at these markets, of course. Now a downdraft underway. You can see the S&P 500 off by about 0.2%. A lot of that pain is coming in big tech, specifically in Nvidia, and that's why you see the NASDAQ 100 off to the tune of about 0.8%. If you're looking for a haven, you'll find it in the bond market. You have 10-year Treasury yields currently lower by about 6 basis points, but still, Matt, we are hovering around 4% on that 10-year Treasury yield. Yeah, it's interesting. Goldman Sachs shares are now down only a fraction of 1%, but, you know, they had a great earnings report this morning, the best quarter 45% surge in profit, and you're right, the traders really stepped up in a big way, not seeing it in the stock right now. Yeah, no, and Citi is off 2%. They also had a great
trading quarter. Tomorrow on Open Interest, tune in for our interview with Morgan Stanley CEO Ted Pick. That's at 10:30 a.m. New York time. This is Bloomberg.